Good morning, everybody, and welcome to our February webinar, financial reporting webinar. It's our second webinar for this year, and today we're looking at practical issues when implementing IFRS 15. And you will remember that in January, we looked at practical issues when implementing IFRS 16. Now, today, again, I have with me Kevin Frobus from our Sydney office. And as you know, my name's Aletta Boshoff. So, good morning, Kevin.
Good morning.
So, the reason for this webinar and this particular topic is that most for-profit entities will have completed 1 year under the new IFRS 15 by 30 June 2019. So most not-for-profit entities are already within their first year of implementing and adopting IFRS 15, and it's now that all the issues and practical implementation issues are coming to the fore. So if we look at the effective date of IFRS 15, it was effective for years beginning on or after 1 January 2018. Therefore, for those with 31 December year ends, 31 December 2018 financial statements would already include IFRS 15, and a lot of them are currently being audited. And if you've got a 30 June year end, we're talking 30 June 2019. So we thought it's a good time to look at some of the practical issues that we are seeing and encountering and solving at the moment. So the real life issues that we're dealing with, or that we'll discuss here, will result from some of the IFRIC discussions, decisions, even agenda rejections, and we've looked at that because that is reflective of problems that's been raised with IFRIC and considered. And then we're also going to discuss a number of issues that are based on our involvement with our clients. Now, our involvement as an BDO IFRS advisory team, first of all, there's a number of clients that come to us that would like IFRS advice around transitioning to IFRS 15, or the best way to do it, to help them do calculations, develop accounting policies, etc., and we help them. But we also, as a team, getting involved with some of our audit clients, because some of the audit clients would say to their audit partners and staff that they know they need to do an assessment, they know they need to implement IFRS 15, but they're looking for a little bit more guidance on how to do it. Now, obviously, for audit clients, we can't give them advice, but IFRS Advisory can give them guidance on how to go about it. And then these clients will present what they've done to their audit partners and to the audit staff. I think it's really important, though, to note that clients need to prepare position papers on implementing and applying IFRS 15 to all their contracts. And clients need to present that to audit partners and audit teams for their consideration. Therefore, it's very important that that's something that clients have to do. That assessment is not what the audit is for. The audit is to assess what clients have done, to audit what clients have done. And we think as an IFRS advisory team, that's where we can assist clients to get audit ready. So out of all those activities with non-audit clients and audit clients, we thought we'll identify a number of issues that we would like to highlight to assist you. As you know, we do these monthly financial reporting webinars, and you can register as you've done for this one. And this year, there's a big focus on IFRS 15. So 5 of our 12 scheduled webinars for 2019 is actually discussing IFRS 15. Today we look at the practical issues when implementing IFRS 15. In April we look at practical issues when implementing AASB 1058, and there's that interaction between 1058 and 15 for our not-for-profit clients. In July, we look at the disclosing of IFRS 15, the transitional impact and the normal disclosure requirements of IFRS 15. In September, we look at not-for-profits, how do they disclose the impact of AASB 1058. And then in October, we reflect on the audit season, and we look at lessons learned from implementing IFRS 15 in order to learn from that for the next reporting period. But we've also done a number of webinars on IFRS 15 during 2017 and 2018. So if you want to go back and get more information, in 2017 there was 3 looking at theoretical details, I would say. And in 2018 we stepped it up to transition, risk assessment and problem areas. So today is really a continuation of a series of webinars. We started way back in 2017. We discussed it in 2018 and we're continuing in 2019. I'm now going to hand over to Kevin. Now, Kevin and I have worked with a lot of clients to get them audit ready around IFRS 15, and we've identified a number of potential pitfalls that we want to flag. So, Kevin, I'll throw it over to you.
Thank you, Aletta, and good morning, everybody, from a wet Sydney, it would seem. I'll be talking for the next couple of slides. Aletta's going to drive from Melbourne in terms of the transition, and I'm going to speak through overview and then actually run through some of those examples she referred to. So starting with the overview then of the slides, the revenue standard, look, it is actually just, if you haven't already clicked onto it, an interaction of really 3 new standards that are all contract driven. And the reason why I actually put this slide up is it's an interesting note that the move is coming from a transaction-based standard to a contract-based standard. And that's the first practical issue that we're running into, that manifesting of a change in a transaction invoice type standard to a contract-based standard. And as you can see from this slide, it interacts with the leases standard and the financial instrument standard that we've been looking at for all these months. They're all contract-based standards. So revenue, this is the overarching requirement. You need to recognize revenue for the transfer of promised goods or services arising from contracts with customers in an amount reflects the consideration that you're entitled. So all those words that I've underlined are the ones where the practical issues actually start to jump out at you. This transfer of promised goods and services is becoming problematic, especially in the world of service delivery. The contracts obviously is the point I'm raising, and you'll see that manifest itself in a couple of examples. And then of course the expectation, which really just translates to estimation of consideration. And estimation means calculations which need to be estimated, forward-looking information, and re-estimated at each reporting date. So those are really the manifesting practical issues. If we jump through to the next slide, you can see then that this is actually the change in approach. And the reason why I actually decided to put this slide on is because in working with both audit clients as well as those advisory clients that we're working with, I think the realization is starting to dawn on a number of entities that the transaction-based move towards a contract-based standard is actually having more of an impact on the balance sheet than on the number for revenue in the income statement. The number for revenue in the income statement is revenue which is recognized to depict the transfer of goods and services. But the implication of that is that there is a lot more focus on the assets and liabilities that are balance sheet orientated. So entities are starting to see things like contract assets and contract liabilities and refund liabilities appear on the balance sheet. And in doing the transition, the focus, although it's been on the profit and loss number, the balance sheet has actually been a place where, on a practical level, a lot more focus and a lot more change is starting to appear. So this is actually a big change, and the practical consideration is that even if the revenue number doesn't look that much different, it's actually the related assets and liabilities, what they are called, where they are presented, and how they are classified, that actually can be quite different. And I'll show you a couple of examples as we go. So moving on then to the next slide. This is the 5-step model. I think from a theory point of view, we've probably spoken about this quite a lot over the last 2 years. And that's really the model that's applied by the standard to every contract with a customer. And this is what I mean by that contract focus. The first step, identify the contract. The second step is identify the separate performance obligations. The third step is to determine the transaction price, and that's the estimation of expected consideration from the contract. Allocate that transaction price amongst the performance obligations in step 2, and then recognize the revenue when control passes. And that's a new concept under the standard, really. The traditional concept of percentage of completion for services and risk and rewards for goods isn't necessarily when the revenue is recognized. A word of caution in the application of this model. The model was designed so that each step would be considered in order. In working with a number of clients, there is a tendency to try and deal with all 5 steps all at the same time. The reason why it's been broken into 5 steps is you really need to bed down the answer or the considerations in each step before progressing to the next step. So there's a tendency to say, well, if I'm earning, let's say, a cash non-refundable upfront fee, then that must be when the revenue is recognized, and that must be what the service is. But that's actually looking at, for example, the upfront fee all in one go, rather than saying, well, what am I doing? What am I promising? What is the expected number? How do I allocate that out? And then when do I actually perform? When you actually perform these steps in order of each other, you actually start to get to a radically different answer. And I think the best way to do that is an example. And I love this example because it scares the pants off everybody. It's one of the first examples we ever started to do as a firm way back when it first came out. And it talks about right of return. So this is a goods-focused example. It talks about an entity that sells 200 units of a product to a customer, normally at $80 per unit. Now, in this example, what I've got here is I've outlined what the contract says. So this is a very good representation of what we mean by moving away from a transaction-based revenue model to a contract-based revenue model. Traditionally, what we would have done under this type of scenario is if an entity sold customer 200 units of a product at $80 a unit, the invoice would have said 200 times 80, and that would have been the revenue, and the revenue would have been recognized at transfer of risk and reward, so delivery or dispatch. Under the contract-based model, we apply the 5-step model, and I've already put the first step on the slide. The first step is, what does the terms of the contract say? And in this case, I'm saying, well, this customer has a specific type of arrangement. He gets an early settlement discount of 8%, and he's also been offered a 10% discount on the next order. And this customer has a right of return for defective products, and the entity's best guess is that 5 units of the 200 will be returned for a cash refund. So that is actually on the screen, step 1. If we move then to step 2, the question is, what are the performance obligations? And this is the concept of transfer of goods or services. What is promised in the contract that is a transfer of a good or a service? Now, we can see immediately that the 200 units is the first performance obligation. That's the transfer of 200 goods. But there's also a promise in this contract to deliver a further good in the future at a 10%. So the next order, when it's placed, is a promise for future goods or services, and there's a discount that goes with that. So there's actually 2 performance obligations here. One of them are the existing 200 units, and the second is what we call a material right, the discount that nobody else gets on the second order. Moving along to step 3, transaction price. You can see this is where the estimation comes in. You could see from the example I was giving you that the transaction price involves us saying, what is the amount we expect to be entitled to? Another way of saying that is what's going to ultimately hit our bank account, the net amount in our bank. Well, in this case, it's the 200 units sold times the $80, which is the normal invoice price under a transaction-based approach. But we know that this customer is going to get an early settlement discount, and if history shows that he's always received that, that must be factored in. We also know that a right to return exists for those defective products, which means we're going to actually give back some cash, the refund liability of those 5 units. And that's then the net cash that's going to arrive from this particular arrangement at this particular point. Now, this is where it starts to get interesting, because the transaction price I've worked out here is already discounted, and it shows the transaction price that is going to arise from the delivery of the first 200 units. And already you can see what I mean by contract assets and contract liabilities and refund liabilities. They're all starting to manifest themselves on the balance sheet. Because if we know that we've delivered 200 units, but we know that 5 of them are going to be refunded, we actually need to take some of the transaction price and put it into a refund liability account, because we're going to have to refund that when the 5 defective products are sent back to us. But it also means that the 200 units of product that have been sent to cost of sales from inventory, 5 of those units must be brought back into inventory as a right to receive those units back in. So the inventory actually has a right to receive those 5 units back. There's a refund liability of 5 units sitting on the balance sheet for the cash refund. Now, there are a couple of tricks in the standard that deal with how you account for these assets and liability, and there are some shortcuts which I won't go into, but the concept on the slide that's in front of you is the concept of assets are starting to manifest, liabilities are starting to be created, and we haven't even got to the revenue recognition yet, which is starting to move towards step 4 and 5. So the next step is allocate the transaction price to the 2 performance obligations. Now, this example is made up of a much bigger example, which gets staff to calculate what the material right is worth. But part of the transaction price actually gets allocated to the material right, the future discount. That $700 is actually a calculation of really the option price. You won't be able to get it from the information I've given you on the slide. It's just an example, but there is a way to calculate the value of that option. And then finally, in step 5, you actually then recognize the revenue in proportion to the standalone selling price in step 4. Really, in this example, the key is the 200 units sold at the $80, which would normally be recognized at $16,000 on a transaction-based model, is actually only recognized at $13,736 on delivery, because some of the transaction price has been allocated to a refund liability, some of it has been deferred related to that future discount because there's a future delivery option in this transaction, and also some of the cost of goods sales had come back to inventory as a right to receive those returned products. So the messages are: 1, apply the steps in order; 2, recognize that it's not just about the revenue number, but there's actually a number of assets and liabilities that get brought onto balance sheet and need to be recognized, even for what looks like a simple right of return. Right, we can move on then to the potential impacts. These are the impacts we are seeing dealing with our audit and advisory clients. We are seeing a lot of revenue getting deferred into the future. We are seeing a lot of revenue and patterns of recognition changing to reflect the value transfer to customer. And what I mean by this is revenue is actually all about when does the good or service transfer to the customer and the control of the goods or service. And the best example of that is actually in the service industry. Traditionally, percentage of completion in the service industry was based on models such as cost input. So if you say, well, I recognize revenue on percentage of completion, and that's based on how much cost I've incurred to deliver that to the good, well, that's not necessarily reflective of the value transferred to the customer. The costs incurred by the entity to deliver the product to the customer isn't necessarily the proportion of value transfer to the customer. So some entities that are using cost-based methods to represent value transfer are finding that they actually need to reassess that, and revenue is actually, the pattern of revenue is changing because they have to come up with a different approach to represent how the value transfers to the customer. Cash collections and the revenue recognition are starting to merge further and further apart, or demerge. And it actually has an impact on things like budgeting and forecasting and impairment assessments, because if budgeting and forecasting traditionally focuses on recognizing the revenue number on what's the cash inflow number. But if you think about it, if you are deferring revenue into the future because the revenue is more reflective of value transfer, it is moving further apart from cash collections. So the revenue number is made up more and more of non-cash items, deferrals from previous years that are unwinding. And this is then leading into some of the disclosures that the entities are running into on how the revenue number in the financials actually relates to the balance sheet items and the cash collections. So there's a really interesting value chain that starts to emerge. When do you actually collect the cash? What are the cash collection terms and the repayment terms? And how does that relate to the eventual recognition of the revenue, which is often in the future and sometimes in later financial years? So those are the impacts we are seeing. Moving along to practical issues, I think we've probably covered a lot already, but these are 3 or 4 examples which we've run into in recent months, which I thought would be really good to discuss with you. The first one is the application of step 5 of the step 2 of the 5-step model. That's what is the performance obligation in the case of a service organization. Now, the definition I've put on screen is a performance obligation is a promise to transfer to a customer a good or a service that is distinct, or a series of distinct goods or services that are substantially the same and have the same pattern of transfer. That's a mouthful, and I think we only recognize what some of those words mean when you start to get to worked examples. And so I've put a worked example up. Alette and I have pulled this one from the IFRIC update in September of 2018. Now, the example is an international example at the IFRIC, the International Interpretations Committee. They dealt with this one on an example basis, but it actually has many, many different practical application issues, which we're actually seeing in other types of clients, and I'll mention those in a moment. But the basic example was a stock exchange provider. It provides a listing service to a customer. What this is, stock exchange promises to transfer admission service that is distinct from a listing service. Now, lots of fancy words there, but really what they're saying is the company wants to list onto a stock exchange, and the stock exchange provides the listing services, which normally mean things like due diligence and application process and notifying dealers and publications, all those activities or tasks that need to be performed in order for the entity to eventually get listed, and then on an ongoing basis to be listed once it's actually achieved the listing. Now, what this particular provider does is they charge a non-refundable upfront fee on initial listing, as well as the ongoing listing fee, so the annual or monthly or quarterly listing fee once the entity is actually listed. Various tasks are performed, as I said, to actually get to the listing. And the question really is what's the service and what's the good or service that's being transferred? Now, traditionally, what would happen in this case is the stock exchange provider would start to recognize revenue as they perform these tasks. So you might get a whole bunch of revenue being recognized, sometimes even before the listing, but normally a big whack of it would get recognized on the actual listing, and then there would just be sort of like a monthly fee as the listing goes on. The question that was put to the international body was, what are the performance obligations? And they had a look at this. And if we can jump to the next one, Aletta, I think I put this in a whole bunch of bubbles. The first thing that the stock exchange provider has to look at is what's the transfer of the good or service. So performance obligations in step 2 of the 5-step model doesn't include an activity if it does not transfer a good or service to the customer. So the question of all these tasks that are being performed before the listing, such as due diligence and application processing and dealer notice publications, none of those actually transfer a good or service. Those are just activities that are necessary to ultimately transfer the good or service or the promise. So the next thing they looked at was to say something like, well, the existence of the non-refundable upfront fee, does that represent or transfer of a good or service? So this is something that a lot of clients tend to want to default to. They say, well, if we're charging an upfront fee and it's non-refundable, that must be indicative that we've transferred a good or service. And the international body said, no, that's actually not how this works. They moved along and they actually said, well, let's look at this. What's the promise to transfer? The promise that the entity is the customer is looking for is not actually the service of being of listing. It's actually the service of being listed thereafter. Nobody wants the moment of listing and then nothing else. They actually want to be listed on that first day and every day thereafter. So the service on the initial day of listing and the service of being listed each day thereafter is actually the service or the promise that's been offered here. It's not the actual listing and all the tasks that went before it. So in conclusion, what the international body said was, you recognize the revenue in this case using what's called the series provision. What that really means is revenue is recognized from the first day of being listed and each day thereafter, really on a time increment basis. There's no big upfront service provided on the day of listing. The moment of listing and every day thereafter are effectively equal increments of service. So you recognize revenue over the period of listing once it's happened. The upfront fee is deferred. That would be a liability of sorts, a deferred liability of sorts, and you start to recognize revenue on an increment basis on actual listing. There'd be no big upfront listing revenue recognized on the actual day of listing. That is really replaced by this sort of equal increment listing along the way. Now, we've seen this in a number of situations already in different examples. We've seen it on some types of debt management services. Some entities are actually entering into arrangements with creditors on behalf of debtors. And the question you really ask yourself in that case is, what is the service we are providing? Is it the tasks before the agreement is settled, or is it when the agreement is agreed with creditors, or is it the ongoing monthly administration of those agreements? And we're generally finding that, especially with these service type arrangements, the revenue is actually getting recognized really as the ongoing monthly service is provided, opposed to this big upfront revenue at the start, because customers don't want the initial contract negotiation or the initial event. They actually want the event on an ongoing basis each month as an ongoing service element, and that's really how you get to your revenue recognition. So that's the first practical issue, is to really stand back and saying, what is it that you're promising, or more importantly, what does the customer think he's getting, or what is the customer asking you to provide? Right. We can move on then to contract costs, contract assets, and contract liabilities. This is one that really comes up a lot. The contract asset and contract liability concept isn't new. The construction industry will be quite familiar with this. But there is a confusion that's been developing in the industry that a contract cost and a contract asset are the same thing. That's really not the case. And so I thought what I'd do at this point was just remind everybody what these various concepts are. First of all, contract costs. Contract costs under the new revenue standard are really made up of two types of costs: the incremental cost to obtain the contract and the cost to fulfill it. They're fancy words, and I'm going to focus on the costs to fulfill. If you really think about it, costs to fulfill are the good old work in progress costs that are directly related to fulfilling a contract, and those costs would normally accrue or become an asset as you build those costs up over the period before you actually transfer the good or service. In construction contract accounting, that would have been work in progress, and cost to fulfill is the concept under AASB 15 or IFRS 15, which says if you don't have another standard that is capitalizing those costs, you would look to try and capitalize those costs to fulfill under this standard, and then you would amortize those costs in some sort of manner that's consistent with the actual transfer of the good or service. What is contract assets? That I've dealt with on the next slide, because a contract asset actually doesn't relate to the cost at all. The contract asset actually relates to the revenue recognition and the consideration. A contract asset is the debit that arises when you're recognizing the revenue, but you haven't become unconditionally entitled to invoice yet or the actual trade receivable. So if you think about it, if you're not entitled to raise the invoice and you don't have a trade receivable yet, but you've recognized the revenue because the 5-step model says you've transferred goods or services, there's a debit side to the revenue transaction which you need to put somewhere, and that is a contract asset. And it works the other way as well. If you've actually have become entitled to invoice and you have collected the money, but you haven't actually delivered the work yet, the other side of the receivable in that case would be a contract liability or deferred revenue. So those concepts manifest themselves quite readily, and this is what we meant by understanding the difference between the revenue recognition and the cash collections, and because there are so many entities starting to defer revenue into the future, the gap between the actual cash collection or the right to collect the cash or invoice the cash and the actual revenue recognition, that gap is starting to widen. And in that period, we're seeing more and more contract assets and contract liabilities emerge. The contract asset is particularly interesting because it's not actually a receivable under the financial instrument standard. It's a contract asset under the revenue standard. It's the other side of a revenue entry when you haven't become unconditionally entitled to actually invoice. But it does act like a receivable under the financial instrument standard. It needs to be assessed for impairment and so forth as if it was a financial instrument or a receivable, because it ultimately will become one when you are entitled to raise that invoice. But it does actually get presented separately because it does actually arise under a different standard, and its measurement is slightly different. Its measurement is essentially the other side of the revenue transaction, whereas the trade receivable, when it does arrive, is the fair value of the receivable. And so there are some nuances that go with that, which you really should think about before you actually start to recognize them in measurement. And we are giving a lot of guidance and advisory work on that concept. Mortgage brokers or brokers in general are finding the contract asset to be an interesting anomaly because they actually, in that scenario, there is a mismatch between when they actually provide the broking service and when they're actually entitled to collect, which is normally over a period of X number of years from the lender or whoever they represent. So the broking industry is having some fun with the contract asset concept. All right. I'll jump off to the other examples I had, and this is scope. Aletta and I have actually been talking about this a lot lately because the new revenue standard very, very clearly outlines how to deal with various parts of a contract which actually fall into another accounting standard. And this comes back to the concept right at the start where we said that IFRS 15 is really one of 3 standards that deal with contract accounting, the other ones being leases and financial instrument, and they all interact to some degree. And IFRS 15 very clearly says that if you do have one component of a contract that belongs in another standard, you really should go look at that other standard first and figure out how you might break this contract up and account for it. So it's a very fancy diagram that's on the screen right now. We've taken this from BDO's IFRS in Practice publication, which is available on our website. But the best way to see it is actually in an example. And so we've given you an example of one that we keep running into, and that's in the financial services sector or dealing with financial products. Because obviously with financial services or financial products, the candidate other standard is the financial instrument standard. And you can very quickly end up in the financial instrument standard, even though you would ordinarily see this as a revenue transaction with a customer. Now, this is a highly simplified example, which perhaps maybe takes some of the reality out because I've tried to cover a number of bases with this example. So this example might remove some of the reality from how things are done, especially in Australia with responsible entities and so forth. But it does try to demonstrate the point. And what I've taken is we've got an investment manager and he originates a loan, in other words, a financial asset, to earn return from borrowers for investor customers. So we really got this investment manager who's arranging for loans to a borrower, and there are investors who are the customers who are providing the funds to then invest in with borrowers into various financial assets. The investment manager earns a one-off fee paid for by the borrower and accounts for that as an establishment fee on settlement of the loan. The manager does the credit checks before the loan is granted and collects repayments each month. Now, this is important because this is very similar to the stock exchange listing example we put up. You've got this investment manager who's doing all these activities before the loan is created. There's money coming in from the investors, and really once the credit checks are done and the borrowers have been assessed, this loan is set up, which then becomes generates a return for the investors, for the investor customers. But before that all happens, there's all these credit checks that happen. And then once the loan is put in place, the investment manager manages that loan, collecting the repayments each month, following up when there's delinquencies and so forth. And you can already see that all the tasks before the loan is originated are probably not revenue related. They don't actually transfer good or service. The good or service is actually after the origination of the loan. And you can already see there's a service being the ongoing administration each month after the loan originates. So that's the basic fact pattern. Current accounting, it's a bit opaque. I think we're finding that there are a number of investment managers who account for that revenue currently as an establishment fee income. So on settlement of the loan, they say, all right, I've earned my establishment fee, and off we go. Now, that is pretty much allowed under IAS 18, depending on the type of investment manager you are. But under the new standard, it's very clear. You need to first look whether you are covered by IFRS 9. And if, for example, you happen to also record the financial asset on your books, let's say the investment manager actually has that financial asset on his book, then this one-off establishment fee at the start would actually be a transaction cost under IFRS 9. And so in that scenario, there'd be nothing left to be accounted for under the IFRS 15 standard. The fee is a transaction cost. It's accounted for under IFRS 9. It affects the effective interest rate of that borrowing, that financial asset with the borrower. There's no revenue recognized in accordance with IFRS 15. Doesn't matter how it's been structured and who's making the payment. On a very simplified basis, because IFRS 9 covers that whole contract, including the establishment fee paid on establishing or originating the loan, IFRS 9 covers the transaction, and you don't come back to 15 for anything else. A slight variation to that fact pattern is if the manager is an intermediary or agent, I'm going to call him a for-hire investment manager. In other words, he's really taking a commission or a cut on originating the loan, and the loan is actually off the books in somebody else's books. So it can't be a transaction cost under IFRS 9. In that case, it is for management services, and the revenue is recognized under IFRS 15 on a monthly service as the service is transferred to the customer. Now, I've underlined customer there because the biggest consideration under this scenario is who's the customer. Who are you acting for as investment manager? Is it the borrower or is it the investor? And when is the service provided? And just like the stock exchange listing example, it's most likely not going to be on originating of the loan. It's going to be over the months that the loan is managed and collections are for repayments are collected. Now, I have to just say at this point that this is, as I said, it's almost a simplified example to demonstrate the concepts of the scope and how the standard interacts with other standards, and that different fact patterns and different arrangements will or possibly have different answers. And I think you should seek some guidance on this, or really just think about the application of this in your scenario. It is a demonstrating concept example, and I think there is an enormous amount of debate that entities are having on the application of this concept, especially with financial services and products. The key takeaway, though, is IFRS 9 applies first, to the contract if it's a financial instrument or the component of the financial instrument before IFRS 15 does. And in some cases, IFRS 15 won't have anything left to be accounted for as a revenue transaction. We'll see if the questions are hot and fast after this one, Aletta, on that one. I think that one's going to cause a bit of debate. Modifications. This is also just something, a very fancy diagram, also taken from our IFRS in Practice book. But the modifications are actually proving quite interesting for a number of organizations. This is when you actually modify the scope or timing of the contract. So at a later stage, you agree with your customer to change what you're going to do or the amount you're going to charge for it. And there are a number of alternative ways to account for these, depending on what's been offered and how the price has been changed. And there's no way to get into this on a webinar, but I'll give you a short example again of one that's pretty basic on how it brings us back to what's the contract as opposed to what's the transaction. And I'll come back to my 200 units at $80. I like this example a lot. There's two modifications that I've presented to you. The first modification is I'm an entity, I'm selling 200 units to my customer at $80 a unit. I've already delivered 150 units and I've got 50 units still to go. And then what happens is the entity, through the sales manager, agrees to deliver a further 50 units at the latest selling price of $75 per unit. Now, under current accounting as well as under the new accounting, the answer will look like this. You already delivered 150 units. You've got another 50 units to go at the original $80. And now you've got a further 50 at the 75 units, which would be effectively a brand new contract at the new standalone selling price. And I think that's probably correct both under the old and the new standards. That's how anybody would do it. You can see there that the invoicing would probably match the way that the revenue standard applies it. You've got a brand new contract at 50 units for $75. But I'll change the example slightly, and this is what I mean by contract accounting and understanding the relationships with customers. If I take modification B, you've got 150 units already delivered. 50 units are still to be delivered of the original 200. And now the sales manager agrees to deliver the further 50 units at a $65 price, being a $10 discount on the $75 selling price. And the reason why they've given those further 50 units at a $10 discount is to compensate for poor service to date. And you can already see that the further 50, which will bear a $10 discount on those further 50, actually relates to the 150 already delivered because it was poor service to date. So if I look at this example, you actually have an immediate adjustment to revenue because you've actually agreed to a refund liability of $500. The 50 remaining units should still be delivered at the original price of 80, and the further 50 will be at the $75 per unit selling price because they are actually being sold at that price. The discount that will be offered on them relates to the 150 already delivered. Now, once again, facts and circumstances may change that, and this is a very high-level general example, but it shows the concept that depending on the modification, the reasons why, how it's changed the scope, and how you've actually offered those units, you can get a very different answer because it's contract-based, it's customer relation-based, and it's what was agreed with the customer. Did it provide promises of goods and services? How did it affect the transaction price? And how is that allocated amongst those items that have already been delivered versus those that are going to be delivered? All right, I think those were the examples we had, Aletta. Oh, I actually forgot about this one. I put this one in just towards the end, which was something that I think the real estate industry is probably would like some clarity on. These are three interpretations. They're about a year old now. They came out in March 2018, but we are running into them a lot. And it's actually about the recognition of revenue for real estate, specifically in residential units, building of multi-unit developments. And the key question there is, are you recognizing revenue over time or at a point in time? Traditionally, over time might have been the way to go. There were interpretations in the past that were issued on this, but the interpretation committee has put together an interpretation really on three questions, which tries to interpret when would overtime apply and they really are looking to interpret the three conditions for overtime recognition. So overtime recognition of revenue is when the customer simultaneously receives and consumes the benefit as the entity performs. The other option is when an asset is created or enhanced, which is controlled by the customer. And the third one is when the entity has an alternative use for the asset and is entitled to enforceable rights to payment for performance to date. And that last one in particular is the interesting one, because when you are selling units before they're constructed, taking a 10% deposit, let's say, and there are various terms in the contract that talk about enforceability of the right to payment for the work done to date. How is that interpreted in accordance with standard? It is a legal interpretation, which then feeds into the accounting. So the interpretation has issued these three interpretations. They are very specific fact patterns, so they're really an interesting read because they give the fact patterns of the three questions and then they interpret it in accordance with the standard. Now, I haven't gone into much detail on this. The next slide is just a summary of roughly where they're heading towards. But the one that they deal with first is when there's a right to undivided interest in land. It talks about how the customer pays a portion of the purchase price. It talks about the ability to agree design changes. It talks about termination penalties for cancellation. And then it goes and interprets those three criteria and comes to the conclusion that none of the overtime criteria are met, because it actually interprets really the third one, which is, are you entitled to consideration for work performed to date, and whether or not there's an alternative use of this for the developer. The other two examples deal with concepts like land transfer at the outset and also the ability to realize proceeds through resale. So for example, if you have a contract with a customer who's bought into a multi-unit residential development and they are entitled to unsell that before development is complete, so resale, and the resale proceeds would really be the settlement of the contract to the customer. How does that impact the standard? That is common, and they deal with that example as well. But careful consideration of the legal requirements is required. And I must just point out here, these three interpretations were to the international body from another country. I'm actually going to get this wrong, but it may have been Argentina or Hong Kong. I can't remember which one, but they actually came from another country. And obviously the legal requirements in those countries were relevant to the questions. We have had debates amongst the IFRS advisory team within the firm, and we realize that in Australia, it's not only Australian federal law, but there's actually specific state laws that actually apply and may have an impact on these types of decisions. And so you just need to carefully consider those and obviously seek the guidance or advice that you need to try and apply that before adopting the standard in its entirety. That may have been the quickest presentation I ever did, Aletta. And I think it does actually cover the points we wanted to on the practical issues.
Thank you very much, Kevin. I appreciate that. It was a lot of fast talking, so well done. I suppose we wanted to end off by saying if you need any assistance, so if you're not an audit client, but another client of BDO or others interested in assistance, please contact us on assistance with IFRS 15 implementation. If you're an audit client, please speak to your audit partner. If you need guidance from an IFRS perspective, your audit partner would be able to point you to the appropriate person in the IFRS advisory team to speak to. As always, for audit clients, the first point of contact the audit partner or the audit team. The kind of things that we're currently doing for clients, IFRS clients, audit clients, we could give written advice, guidance, around applying IFRS 15. We could do training or workshops, which we often do to just help people to talk through the issues for their particular organization. So that is also a possibility. We can help with a risk assessment or an impact assessment. We can also talk about consulting and customization of processes. So we often find people that say, we know we have to do it. We know the standard has the perfect way to do it. However, our systems only create this much information. How can we work that information? How can we change that information? What should we add to that information in order to comply with the standard? Policy development and updating accounting policy manuals is something we do, and obviously first-time adoption assessments. So very happy to do any of those. If you want to speak to us, you're more than welcome. And I think I just want to reiterate that it's very important that our clients understand that the impact assessment implementing IFRS 15 is a responsibility of the organization, responsibility of management, and not the responsibility of our auditors. The auditors will come along at the end of the year and audit what you present to them. And it's important to get that independence in place. Then if we look at the monthly financial reporting webinars, just to reiterate, the remaining webinars dealing with IFRS 15 or for revenue recognition for not-for-profits, AASB 1058, if you want to join us. And then also you can look at the recordings, as I've said earlier. You also know that if in the past I've pointed you to our monthly newsletters and also other publications. The other publications that I find particularly useful, or clients find very useful, is the IFRS in Practice publications by BDO Global. There's a brand new one, updated one coming out on IFRS 15 and IFRS 9. It was updated in 2018 as well, so it's a continuous process to update. And there is a very recent one as well on IFRS 16. So please look at those publications available on our website. If you don't find them, please contact me, and please register for the newsletters. In the newsletters, we try and include each and every month an article on one of the 333 or the triple threat accounting standards, 9, 15, 16. And in 2019, we're also trying to include a not-for-profit article in every month, just to stay up to date on the latest developments. So if you're looking for assistance, these would be the key people to contact in the various locations. But also, just to reiterate that we are supported in Australia by a big team, the four of us supported by a big team of, it's actually a team of 18 people in Australia. I also want to point out that you'll see that Susan Oldmeadow Hall has been promoted to a partner from the beginning of this year. Susan is based in Perth, and she's helping Wayne Basford there in Perth. So at the moment, you know, the two partners in Perth, WA, and if you want to contact them, you're more than welcome. But you'll see it's a team with a lot of experience. I've previously talked about the fact that we've got a general counsel helping us, looking at these contracts, but a number of associate directors that are very experienced and have been with BDO for a number of years and worked in this space. So please feel free to contact us if you're looking for assistance. Thank you very much for joining us today for this webinar. Next month, we'll go on and look at practical implementation issues around IFRS 9. And so please join us again next month. Thank you very much. Thank you very much to Kevin for sharing the insights, and we hope you have a good day.